Good morning, everyone. My name is Emma Schumann, and I'm a financial consultant at Codabears. I'm going to go ahead and take myself off camera just so I have a little bit more spacing, but we'll go ahead and get started. Today, we're going to talk about two features that are becoming increasingly important as businesses grow. That would be multi-company, specifically intercompany trading, and financial consolidation in Epicor. Many organizations don't operate as a single legal entity anymore. They may have different manufacturing facilities, international companies, acquisitions, or separate business units. While each company needs to maintain its own financial books, leadership may still need or require one financial picture of the entire business. That's exactly what we'll cover today, how Epicor allows companies to operate independently while still working together. The agenda today, we'll first discuss why businesses would choose to operate in a multi-company database. Then we'll look at Epicor's multi-company functionality and the high-level setup requirements. After that, we'll transition into financial consolidation, covering the setup requirements, the consolidation process, and finally, how to review consolidated financial reporting. So why multi-company? Most of the time, it involves the fact that every legal entity usually has its own tax identification number. Additional reasoning might be due to banking, financial statements, or the company operates under a different tax regulation compared to the parent. Because of that, they need independent accounting records. However, not everything should be duplicated. Most businesses want to share foundational information like customers, vendors, part records, currencies, and even portion of the chart of accounts. In a multi-company database, leadership would want, most of the time, one enterprise-wide view while each company continues operating on its own, and the ability to handle intercompany activities appropriately. That's where Epicor multi-company and consolidation functionality will come into play. Epicor provides a centralized management for multiple companies while allowing each company to remain operationally independent. One of the biggest benefits is automating the intercompany processing. Rather than manually creating documents in two companies, Epicor can automate much of that work. For example, an intercompany purchase order can automatically generate a sales order in another company. Another major benefit is global master data. Instead of maintaining vendors, customers, parts, currencies, or account segments or GL accounts multiple times, businesses can synchronize those records across multiple companies. So a parent could create these records and send them off to the child company. They could do updates and push for those updates to the child company. The child company do have the ability to block those changes if they don't want to get those updates into their system, into their company. Epicor also supports centralized AR and AP processing, which would reduce duplicating administrative work. Instead of processing accounts payables and disbursement via check, ACH, whatever sort of payments that you are doing separately across every child company, you can process and pay all child companies' invoices at the parent company level as well. There's also the functionality of national accounts with credits and AR invoicing being sent automatically. Setting up multi-company is more than simply checking a few boxes. There are several foundational pieces that must be configured correctly. We start that process and begin within external company maintenance. This tells Epicor about the other companies participating in the database. The company ID here is extremely important because it's how Epicor identifies where transactions should be sent and received from. Next is configuring communication through either the multi-company service bus or multi-company direct, depending on the database. The difference between the two. Service bus is used when the two companies are on two different databases, while direct indicates one database with multiple companies. Most of the time, I've seen it being direct, But in the case that we do have a situation where there are two different database, but we need to do some intercompany activities, service bus would be an option we would consider. Then we would shift gears and transition to external company configuration. Here, we define whether we will use the intercompany functionality and what information will be sent between the two companies. I would just like to say that if you have multiple companies that need to do intercompany or any sort of consolidation, each company would require this setup. It's not just a one-time setup, so it would have to be repeated. Every company must have the appropriate customer and supplier records established for the other companies. So if you take a look at the picture I have on this slide, you'll notice that both customer ID, well, first you'll notice that intercompany trading is enabled. If that's enabled, we need to identify the customer ID and supplier ID, which should match to the company that I'm going to do intercompany activities with. The partner supplier ID as well as partner customer ID is the company ID I am currently working in, which is Epic 06, according to this picture. Without these trading relationships, automating intercompany transaction won't function correctly. So I always would take a look here just to make sure setup-wise everything is set up correctly if we are not getting sales order or POs generating correctly. This is also the place where we will review and set up the geo control codes as well as some requirements for consolidation, and we will talk more about that in a few slides. Another major concept when setting up multi-company is global tables. These tables help determine which and what information will be transferred between each company, such as, again, customers, vendors, parts, or currency. And we'll decide whether we're going to maintain those information centrally or separately. So on the slide, you see two screenshots of the global table maintenance. I always get asked whether global table, again, is a one for all, or can I get really granular with it? The answer is yes, you could get granular with it. So on this left-hand side picture, where it says global table maintenance, you'll notice that there's a handful of tables currently already populated. Now, if you're currently missing any global tables, there is a blue box, kind of top right-hand corner of the screen that would say create global table. You would simply click on that, and then it would generate global tables for you. Not every table in Epicor is a global table. There's only a handful. Within the table itself, though, you could identify whether it's for one specific company or all companies. So this is where the granularity comes into play. And then we could take it a step further, where within each table, you'll have options, and you could go through the listing and decide what information I am willing to make global. So if I was going into a customer and using the customer table, I might not want to share address. I might not want to share contact information, but I do care to share their name, their tax ID number, and their terms and payment methods, for example. I would be able to select those, and then it would be removed from available choices to selected choices. And at a very high level, this is how you would set this table up. I would also like to say, if you ever find that information isn't flowing from one company to the next, always just double check this table. You could always unselect your choices and select them just to kind of re-trigger the process and then run the appropriate multi-company direct server process to push that information forward. So we're going to walk through an example just to kind of get our heads wrapped around what intercompany transaction could look like. So let's say you work in Company A. Company A and Company B are sister companies. Company A produces a product that Company B purchases as material to manufactured part. More specifically, Company A is a supplier to Company B. Company B sends a purchase order to Company A. You create a sales order from the incoming intercompany purchase order. If required, you can suggest changes to the intercompany PO and email them to Company B through send intercompany purchase order suggestions. Company B can reject or accept these suggestions through the Change PO Suggestion app. Kinetic then updates the sales order within your database with the response to the suggestion. Company B can also interpret these suggestions as forecast information. This functionality improves communication between the two companies. As you send suggestions against the sales order created from an intercompany purchase order, again, the intercompany trader's PO records automatically updates with this information. So that was the send intercompany PO, but what about the incoming intercompany PO suggestion? So incoming intercompany PO suggestion allows you to convert the PO created in one company into a sales order within your company. It again improves communication between the two companies. As you send releases against the sales order created from a purchase order, the company PO record automatically updates with this release information. If the two company uses different currency, for example, euros or dollars, Kinetic would be able to convert the monetary values to the correct local currency, given that the exchange rate is set up correctly. Then we have the intercompany PO receipt. We have to make sure we do the intercompany PO receipt correctly, which is very different than the receipt entry that we would be used to. The reason why is we want to make sure we are clearing these intercompany POs, which Epicor kind of segregates out from a normal PO. To get information to and from each company, there's a process that needs to be processed for information to move. That process is called Multi-Company Direct Server. This process can be scheduled and automated. If it's not scheduled and if it's not automated, then we have to make sure that we are consciously running it often, or else information will not get pushed over. This process sometimes does require us to run multiple times before information or new setup is pushed. I like to always recommend that we start this process in the parent company and then let that process finish before we run this process in the child company. I find that I have more success that way. Epicor consolidation functionality. So now that we talked about operational processing, let's shift gears to financial reporting. Multi-company keeps companies operating separately. Consolidation would bring all those financial results together. Epicor allows organizations to combine multiple legal entities into one consolidated financial statement. Even if subsidiaries use different currency or different chart of accounts, Epicor can translate currency, map accounts to a common structure, and produce consolidated balance sheets, income statements, and trial balances. One important part to mention is elimination. Epicor does not automatically identify intercompany transaction, nor would it handle the elimination part. Instead, organizations, businesses would complete their normal accounting process first. Elimination entries are then recorded manually with a journal entry in the consolidated book. These journal entries only affect consolidating reporting and should not touch your normal subledgers. Benefits of consolidation are quite straightforward. Organizations would reduce spreadsheet-based consolidation. There would no longer be a need to extract out data in the system and merging them in an Excel file and do data manipulation that way. Financial reporting becomes more consistent, as well as month-end closing also becomes faster. More importantly, though, leadership gained visibility across the entire enterprise from a single set of financial statements. However, before consolidation can happen, several foundational pieces must exist. Again, external company maintenance and configuration must already or be configured. The next crucial requirement is the chart of accounts. Either every company shares the same chart of accounts with the same COA ID, or companies would need to be mapped to an intermediate chart of accounts. One thing to remember, and one of the most common setup mistakes, is that the intermediate book and the consolidated book must share the same chart of account ID. If the child company COA is different from the parent, account segment mapping is then used to translate local account structures into the corporate structure. There are two options available for COA mapping. We can map based off of segments, chart, division, department, or any other segments that you might have, or we can map based on GL accounts. I find that mapping on segment is easier, and there's also a DMT file to handle this process. Finally, consolidation books are needed. If needed, this is used as the intermediate book, which is different than a standard book. At one point, we would also need to have a secondary standard book, which is the actual consolidated book. A little bit confusing there. The type being consolidated doesn't mean that it is actually the consolidated book. It just means that that would be your intermediate book. These books must use the same physical calendar as the parent company. Next, we define how financial data will actually move. First would be the consolidation rate types. Similar to how you would have rate types for currency, we need to define the rate type for consolidation. Typically, balance sheet accounts use period end exchange rate. Whatever the period end exchange rate would be is the exchange rate that the system would use. Income statement accounts would typically use daily average rates. Then we define the consolidation type. There are two types. There's balance and periodic movement. Businesses generally choose balance consolidation for your balance sheet and periodic movement for your income statement. Finally, with those two being set up, we can now shift gears into consolidation definition. Consolidation definition really is the bread and butter of a consolidation. It controls your source book, the main book that has your typical transaction in the company. It has your intermediate book if you decide to use an intermediate book, as well as the target book, COA mapping, exchange rate, GL account for booking any gain or loss on exchange rates, as well as posting option, whether we will be doing continuous or periodic consolidation. Think of consolidation definition as the blueprint that tells Epicor exactly how to move financial information from each company into the consolidated book. We would also define the journal entry coding at this point. I always highly recommend that we set up a different consolidation journal code for easier identification due to the volume of transaction that can occur with consolidation. And in this case, if something did go wrong, this would be one way we could identify which transaction went wrong. The consolidation process, from a graphic viewpoint, step 1 and step 2 are optional. If you need to create a new chart of account because your child's COA is different than the corporate, you would then go ahead and do step 1. You would then also need to do step 2 to tell the system if account A is this, then it matches up to account B in the parent. Step 3, type of consolidation is important here is because we need to set up the book so that we can link it to the COA that we just created in step 1. So determine whether you are going to need an intermediate book or you're going to book your consolidation straight to the consolidated book. Then you'll set up 4, 5, and 6, just like mentioned in the previous slide. And then you'll finish the consolidation process with consolidate to parent. Consolidate to parent, what is the functionality? So this is where we would trigger the process for consolidation once all setup has been done and once all subsidiary companies have been completed their period and activity. The consolidation process is in numerical order, which is assigned by the system. If you do not finish and keep one consolidation open, you would not be able to post any other future consolidation that comes after. This would be also the place where you would identify exchange rate, fiscal year, and fiscal period. You can override the system exchange rate at this point in time. If you decide to use an intermediate book, there is an additional step that is called transfer intermediate. You would then first post. That post process posts to the intermediate book. Then you would come back into this menu screen, run the transfer intermediate to post to the actual consolidated book. Viewing consolidation financial reports. Obviously, we have the trial balance. You also have the consolidation reports. You can also run financial report from Epicor. If you have set up your financial report using Financial Report Designer, you will want to make sure you review that, make sure it is set up to include child consolidated values. From there, you would be able to run the financial report using this report format called Combine. It's often a slept-on trick in Epicor. If you use the report format Combined, you'll be able to select which book from other companies you want to run this report for. So I could run this report, call it the income statement for company A, B, and C, and it will populate all the values for me without me having to pull from Excel individually, combining it, and then doing data manipulation. There's also additional integration with FP&A and spreadsheet servers, such as or was known as Excel Connect. Good morning, everyone. My name is Emma Schumann, and I'm a financial consultant at Codebears. I'm going to go ahead and take myself off camera just so I have a little